Hello Propenomix people, and welcome to the supplement from the 7th of April 2024, and this one I've called Train on the Tracks. So as you'll know, I like to start with a quote, and this week's is difficult roads often lead to beautiful destinations, and that's by Zig Ziglar, the American author. So before we crack on, some exciting news. 27th of April is the first day of a series of in-person social housing events that Partners in Property are organising. There's going to be 7 speaker slots in total, covering every aspect of social housing. Attendees will be able to walk away with all the nuts and bolts they need to decide whether they want to incorporate social housing within their own property portfolios. The agenda will include why Sue Sims started in social housing as an investor more than 8 years ago. Wayne Millwood, the founder of Room Match, will be outlining all the due diligence you need to undertake when deciding which social housing provider to work with. Mark Turner, the Chief Operating Officer from the Housing Network, will be talking about the future of social housing. A social housing expert mortgage broker will confirm exactly what you need to provide and take into account when you're looking for funding for social housing. And then Pinder Dhaliwal, the MD at Falcon Insurance, will give an overview of how to insure your property that is leased to a social housing provider. I'd also like to share I'm very excited by our upcoming property business workshop, which is happening in only 2.5 weeks' time. Rod Turner and I will be covering due diligence, mergers and acquisitions and joint ventures, with some real-life case studies of deals we've done, the good, the bad and the ugly. The tickets for the workshop are at bit.ly/PBWTWO. The date's Wednesday the 24th of April, and if you haven't booked your ticket yet, please grab one of the last remaining ones because there's only 3 left now. So welcome to the supplement, everyone. Our second short week in a row thanks to Easter. And it felt like that week where everyone tries to pretend there's still 5 working days when really there are 4. It was a bit of a catch-up week here as we've had some flux in the internal team at the HQ of our group operations, and a challenge, but an enjoyable challenge. Macro had a busier week, and it wasn't all roses this time out, which led me to reach for a different title this week. Is everything still on track for this great purple patch, or have the bears had a great week and is the train off course? We need to discuss the Halifax and nationwide house price indices. The PMIs were out, which are always worthy of discussion, mortgage approval rates, and I'll get into more detail about the Bank of England money and credit report for the month, as that gives a deeper dive into exactly what's going on. And, in the least surprising news since man lands on moon, the bond and swap yields. The house price indices then. I've been at the mouthpiece of the megaphone over the extensive growth since the start of 2024, and most, according to Halifax anyway, has evaporated in 1 month. Are they trying to hit their own target of 4% down for the year? I'm only kidding. 1% down in 1 month though, that was their print, and that's significant. Nationwide were less bearish, but their minus 0.2% was still 0.5% under the consensus. What happened? Well, we must remember that their figures are based on loans issued quite heavily. Their own data, whilst they're massive lenders, is only a relatively small percentage of a crowded market, even Halifax. Nationwide's data will be more skewed towards investors and buy-to-let because of their ownership of the mortgage works. On the face of that, you'd say that investors have been somewhat active, whereas resi punters less so. When you compare it with the real-time sales agreed data, of which Christopher Watkin is a great source and distributor if you don't already follow him on socials, this doesn't look to add up. March was a good month for sales agreed, an improvement, 3% or so, in terms of the price of sales agreed per square foot, which is the best metric of those readily available, compared to the end of 2023. So why the incongruence? Not easy to say. No data is perfect. All of those are real-time stats rather than the Landridge, which will update in about 4 to 5 months' time to reflect all of this. So we know the ONS is going to be up about 3% compared to the April-May print in about July or August, because prices move forward in Q1 in terms of sales agreed by that number. What did Halifax themselves say? Firstly, they still printed plus 2% for the quarter, so we wouldn't be overly worried by 1 month's print. They're citing affordability concerns, which I disagree with, to be honest, but also a change in expectations of when rates are going to come down, which may have some truth in it. Although, why hang on if rates aren't coming down as quickly as expected if you're a buyer? Strangely, they've also, in the face of a falling month, completely changed their rhetoric. They cite a more Zoopla-esque style of a limited scope for significant house price increases this year, Need I remind you their forecast is 4% down for the year, or it was. They seem to be already at the stage where they're disowning that. There is some good sense in there. Demand is positive. Mortgage approvals are up to the 10-year average. Prices won't change massively while interest rates stay high. They're still making the same mistake as everyone else by not having inflation in the conversation. Before writing this section, I was listening to The Rest is Politics with Alistair Campbell and Rory Stewart, talking about some universities going bust or being close to it. It's a super podcast. Even Rory had no concept of what inflation has done since 2010, which he estimated at about 30%, when the reality is 60% if you merge CPI and RPI and take a rough average. Inflation blindness is a thing, even for someone as well informed as Rory. It's inflation that will continue to help drive things forward. To have this discussion in early April without the context of massive increases in disposable income that particularly lower paid households are seeing in percentage terms, but all working and pension households are seeing in absolute terms, is just silly. So I'm comfortable we'll have very little to worry about. Based on the logic above, March's ONS print will be based on deals agreed in November or so last year. A different environment indeed, but I doubt it will be a 1% down month. One wobble can be forgiven, basically. What's being conflated is the fact that this week's mortgage offer data release was based on what happened in February, not March. So when the early May Bank of England Money and Credit Report comes out, we can expect mortgage approvals to have dropped right back to the low 50,000s or similar. Talking of mortgage approvals, though, that did make plenty of headlines. The number? 60,383. Above the magic 60k, which, as stated, is the 10-year average. I personally would be happier to see it up at 65 to 70k, as that looks like a healthy and growing market. But that's a bit of a pipe dream with interest rates still at the levels they are. That's going to take a bond yield for the 5-year at around 3.25% or lower, with some stability, I'd say. Still, the consensus was a similar print to January's number of just over 56k, and it was a nice surprise to see the 60k mark breached. It generated a lot of positive headlines, which will largely be undone in a month's time as per the above, because then we'll be looking at March's figures, and those approvals will be lower, based on what the Halifax and the Nationwide are saying. Still, what it means is that the market could cope with rates at or around 4% for the best buys on the 5-year in the resi market. All of the tricks from the toolbox, higher arrangement fees, longer terms, interest-only periods for resi buyers and a few more, have worked to keep the market relatively healthy, and credit, no pun intended, should be given where credit is due here. The regulator has done a very decent job since 2009. Yes, it was woefully inadequate before that, but blaming one single party or actor is not feasible. Everyone in the system was at it, and they very rarely receive any public praise for it. So I'm going to go deeper into the money and credit report shortly. So, suffice to say, good news, but temporary good news, and I expect the direction of travel to reverse again next month to leave a few scratching their heads, which they shouldn't really be doing, because we don't yet, until rates do work their way down, have the ingredients for a crack-up boom. Inflation will drive prices forward, though, I say again. On to my darlings of real-time statistics, the Purchasing Managers Indices, the PMIs. The PMIs look healthy. Services has had its wings clipped slightly for March to 53.1 from a 53.8 print last time out. Slightly under consensus, but just the right side of that very healthy 53. Construction and manufacturing both limped over the 50 mark, which is good news. The effects of the construction inflation situation and the manufacturing bubble that deflated quite significantly post-PPE and COVID look to have worked their way through the system. This will still hurt housing starts for many months to come, in my view, and some reality needs to set in regarding pricing. The composite index thus printed 52.8, which compared to the previous 53 is a tiny step in the wrong direction, but nothing to be concerned about. It cements Q1 as a growth quarter for the UK economy, in my view, as I've seen nothing from the more real-time stats and surveys to suggest anything else. March could well be a flatter and more disappointing month, but February should have done okay. We'll find out later this month. And something like the 0.4% print I've suggested for Q1 GDP should be what comes back. More PMIs in a few weeks when we get the April flash numbers. On to the ever-presents then, the bond and swap market. Only 4 trading days again, and it was a tougher week this week. We gave up most of those gains from a couple of weeks back as the yield hardened from 3.832 at the open to 3.936 at the close on the 5-year government gilt, with a couple of peaks above 3.95, approaching that 4% number again. I did say last week that those market moves suggested very slightly that we move up again before we move down, slowly, and sadly that's come to pass. Still, we can't mourn 0.1%. Well, we can, and I am. But it is the direction that we want to see, let's face it. The positive economic news allows the yields to harden because it doesn't look at all critical that rates have dropped at the moment. The system is working as far as the Bank of England sees it. The swap's 3.82 on Thursday's close on the 5-year SONIA swap, that mortgage market money without any profit margin or operational costs supplied, remember, which is still trading below the market gilt, which closed at 3.885 at the 5-year on Thursday. Supply of money is still exceeding demand, and it still remains to be the case that rates need to get a chunk cheaper before demand for money exceeds supply again, or the property market needs to hot up. But it'll only hot up if interest rates are lowered, unless there is an external incentive, such as a stamp duty holiday or other fiscal intervention by the government, which looks unlikely at this point in this Parliament and the year. OK, the main course then. Firstly, the fish course, actually, the Bank of England's money and credit report. A monthly fixture, but one I only tend to tuck into once per quarter, as not enough really changes within a month. But I thought it was worth a revisit as we've entered Q2 of 24. The bullets first with some commentary. Individuals borrowed, on net, 1.5 billion of mortgage debt in February, compared to 1.1 billion of net repayments in January. We knew an improvement was coming as the rates had dropped nicely, and it took the world a couple of weeks to wake up in January 2024 as usual. Net mortgage approvals for house purchases rose from 56,100 in January to 60,400 in February. Net approvals for remortgaging also increased from 30,900 to 37,700 during this period. Good news on mortgages to the 10-year average. Not quite healthy as yet, as that's more like 65 to 70 per month, as I said. A significant improvement on remortgages, a 22% increase as people stop waiting and accept that the rates are where they are, maybe. The effective interest rate, the actual interest paid on newly drawn mortgages, fell by 29 basis points to 4.9 in February. That's a big drop as well, making a significant difference. Far better than the average rate in the market at the moment, which is more like 5.25. The fact that people had products secured and were then able to trade down their rates as they neared completion, as bond yields were falling, will have helped with this. I'll be interested to see March's figure, but this is well in the money versus the 5.5% stress test rate that the vast majority of mortgages have been stress tested at since 2012 and the Mortgage Market Review. Net consumer credit borrowing decreased to 1.4 billion in February from 1.8 billion in January. I wouldn't read too much into this. There'll always be extensive consumer credit borrowing in January to plug gaps left from Christmas, so perhaps reserve judgment until next month. UK non-financial businesses, PNFCs as they call them, and public corporations repaid on net 3.3 billion of loans to banks and building societies in February, compared to 0.2 billion of net repayments in January. Now this seems interesting. I always caution against analysing 1 month's movement too heavily, but have to balance that against trying to be as real-time as possible in my analysis to make it useful. That repayment says two things to me. One, if companies are not finding investment opportunities that offer them a better opportunity than paying down debt, then they'll pay down the debt. And two, the companies are considering debt to be expensive at the moment perhaps, and thus choosing to pay down with their free cash flow positions. So is that a bad thing? Well, not necessarily, because obviously we want solvent companies, but not having the investment opportunities that stack up in the medium term would of course be a continuation of a lack of investment that's been a UK problem since 2007. The net flow of sterling money, known as M4EX, continued to be volatile month on month. M4EX rose by 7.2 billion in February compared to a flow of minus 0.2 billion in January. This was mainly driven by households' holdings of money, which rose by £6 billion in February, down from a 6.6 billion increase in January. I like M2 as the proxy for the money supply conversation. It's much easier to understand. But look at the net flow of monies to households over those past 2 months. Significant. And let me tell you, inflationary. The money supply is considered by some schools of economics to be a much better predictor of inflation because money needs to find a home at the simplest level. Where will that home be for households? More on that in the ONS report analysis in a short while. The flow of sterling net lending to private sector companies and households, M4LEX, amounted to minus 15.8 billion in February, down from minus 3.2 billion in January. This was mainly driven by a further decrease in the flow of lending to non-intermediate other financial corporations. Less lending pertaining to the same logic as the point on repayments already made. Lending generally is needed for growth, but price does matter, of course. Fiscal drag lower, but investment lower, and that's not good in an environment where investment is already too low. My point about a healthy market is made by the graph accompanying this week's supplement. Between 2014 and the end of 2019, I think it's fair to call that a functioning, fairly stable market. Sure, some bubbles in places, but I think that's always the way. There's a few more points that don't make the headlines, but I believe that we should be aware of. So, the effective interest rate, the actual interest paid on newly drawn mortgages, fell by 29 basis points to 4.9% in February. The rate on the outstanding stock of mortgages increased by 7 basis points, from 3.41 in January to 3.48 in February. Now, the first bit did make the headlines, as I've already said it, but should be put side by side with the second bit. So the real cost that the UK is currently bearing in terms of mortgage debt, on average, is 3.48%. If those mortgages all started in February 2024, that rate would have been 4.9%. Some people would be broke, some properties would be sold. It doesn't happen overnight like that, but that is a 41% increase, or a 29% discount if you prefer to look at it that way. While that existing debt number is rising towards the new number, which it will every month until those numbers flip-flop, by about 2% per month in relative terms, that makes sense again, I suppose, because in a 5-year cycle, about 1/60th of mortgages would drop off each month. It isn't as simple as that, of course, but there's enough truth to it. That lag continues, and my point would be that the 70% of impact of interest rate rises has already been bedded into the economy, as quoted by the Bank of England, is nowhere near 70% in this part of the market, more like less than halfway. Then look at this household arbitrage situation, which is one reason why the households are doing okay, or even well, thank you very much. And yes, averages are dangerous. Yes, some people are struggling. No, I'm not minimising that. The effective interest rate paid on individuals' new time deposits with banks and building societies fell by 7 basis points to 4.46%. The effective rate on the outstanding stock of time deposits increased by 5 basis points to 3.81% in February, and the effective rate on stock sight deposits also rose by 4 basis points to 2.11. So, newly drawn mortgages 4.9, newly deposited funds 4.46. That's some razor-thin margin right there, 0.44%. People are currently able to invest at a higher rate than they've borrowed historically on average, although taxation likely puts paid to that being an arbitrage situation. But you can see how helpful that is. Let's look back in anger for a moment. Pick 5 years ago as our typical mortgage cycle, February 2019's Bank Money and Credit Report. The sad news is the Bank of England weren't even tracking these metrics 5 years ago in these reports. Mind-blowing in a way that even at the top level of government and NGOs, we still tend to be reactive rather than proactive. I can throw a dart at it though. Average rate on newly drawn mortgages back then, I'm going to say 2.7. Average debt stock, more like 3%, sorry, not vastly different to now. That number going downwards, not upwards at the time, because the new debt number was lower than the existing number, because bond yields had been falling. That does, if I'm right of course, put much more into perspective just how little has really changed in spite of interest rates going up quite so much. That only applies to those with fixed debt, of course, because those on variable rates have taken the full force of the rates moving. Next, the change in lending. The annual growth rate of borrowing by large businesses was 1.4% in February, up from 1.2% in January. The growth rate of lending to SMEs decreased slightly further, from minus 4.8% in January to minus 4.9% in February. What we already always know, the smaller businesses can't get the money when they need it, and with reduced margins, they can't borrow their way out of the hole, but it becomes a self-fulfilling prophecy. This is why funding for lending existed in 2012, and also why more initiatives are needed to help businesses out of their post-COVID holes. Here's why. The average cost of new borrowing from banks by UK PNFCs fell by 4 basis points, from 7.01 in January to 6.97 in February. Half a percentage point premium for being a small and medium enterprise, because, by contrast, the effective interest rate on new loans to SMEs increased by 5 basis points to 7.55 in February. So the premium on the smaller companies seems to be rising, whereas the bigger borrowers are paying a bit less. But that's some increase based on their old rates, though, isn't it? Their existing stock of debt number isn't a known number, more's the pity, by the looks of it. But as you can see, they're sitting 2.5% or so above the newly drawn mortgage rates. So, monetarists will tell you, money supply goes up, money needs a home. The money supply, after being trimmed, is going back up. Does quantitative tightening affect this? No, but the lack of easing does. In tightening, the bonds are being sold into the secondary market, not retired. Some are retired, the same number that were being retired since before the last round of QE. Confused? I don't blame you. The point is, the money and the interest is going somewhere else rather than to the Bank of England, which is effectively the Treasury. That hasn't helped to explain it either, has it? Money supply down. The action that was needed to see inflation come back into line has happened since October 2022. It's flatlined a bit now after hitting a bottom in October 2023, and isn't yet on its way back up properly, but is about where it was in March 2022, which was up about 22% in 2 years, pretty much the inflation that has played out now in the period since pre-COVID. I'm still watching it closely month on month. It compares favourably to the US, who pumped theirs up 40% over the same time period, and it stands to reason they've got more secular inflation to deal with than the UK does. But the numbers are still just too high in services and wages for comfort. Let's ensure to watch the money supply over the coming 6 months very closely. But this is a point where the UK and the US can and do diverge based on this underlying point. I hope you enjoyed the turbot. Now for the steak, the meat from the quarterly ONS household accounts for Q4 2023. The ONS are lagging on a lot of this stuff with no release dates ready for things like household balance sheets, which I like a lot. But perhaps this is another methodology change. But I can't find any communications about it. We're still waiting for the 2023 figures. Anyway, the quarterly sector accounts come out around 3 months in arrears, at the end of the next quarter basically. Headlines and analysis first. The household savings ratio is estimated to have increased to 10.2% in quarter 4. That's October to December 2023, from 10.1% in the previous quarter. This is a big number in percentage terms, but recessionary noises may have forced it up rather than down. Pre-COVID, it looked more like 5%. In better times, 7 to 8% would be average. The increase in the saving ratio was driven by a rise in net social benefits, other than social transfers in kind, of 3.9 billion, together with increased employers' social contributions of 2 billion and wages and salaries of 1.4 billion. This is likely warm home payments and also second instalments of cost of living payments, which were £300 per household for qualifying households, that took place in quarter 4 2023. That's alongside wage rises, of course. Real households' disposable income, RHDI, is estimated to have grown by 0.7%, following broadly flat growth in quarter 3, July to September 23. Still moving forwards, not backwards, with a major increase coming for H1 2024 in my opinion, and from the figures we've seen thus far. Within RHDI, nominal gross disposable income increased by 1.1%. Not bad for a quarter, but less than might be expected. The UK's borrowing position with the rest of the world as a percentage of gross domestic product is estimated to have increased to 3.3% in quarter 4 from 2.9% in quarter 3. This is an interesting angle. Of course, when the Bank of England owns the debt and isn't selling it off as part of the quantitative tightening programme, then it isn't overseas, whereas selling it off likely does send it overseas. Is this uncomfortably high? No. Indeed, I'm sure we'd love to send some more overseas. The US proportion of foreign-owned debt is 10 times this, 33% of their government debt, as the world's global reserve currency. Non-financial corporations increased their net borrowing to 2.7% of GDP, from 1.5% of GDP in quarter 3 23. This was driven by falls in gross operating surplus of 4.2 billion and net property income of 3.8 billion. More borrowing last quarter, but less going on at the moment, as we've seen in the more real-time report from the bank. Households decreased their net lending to 2.9% of GDP in quarter 4 23, compared with 3.1% of GDP the previous quarter. This was driven by falls in net capital transfers of 2.8 billion, the adjustment for pensions entitlements of 2.7 billion, and net property income of 2.4 billion. Paying down and borrowing less as the price was high, basically, in sync with the Bank of England analysis and the trend that's continued into 2024. General government saw a decrease in their net borrowing position to 4.6% of GDP in quarter 4 2023, from 4.8% as a percentage of GDP in quarter 3. Yet, still borrowing, as always. The biggest factor for me here is RHDI. I adore RHDI as a metric because it is households that rent properties, not individuals. If there are more people in the household, the rent paid per capita is also lower, effectively. This is a very sterile view, of course, typical economics. If it means people over-occupying properties, or having flats instead of houses because they're cheaper, or otherwise, that's a sad state of affairs. That's also been the state of affairs in the capital city for at least a decade, if not more. Grenfell spoke volumes in that department, and that situation has worsened significantly since then, particularly in the past couple of years. However, in the absence of a better metric, and my argument is that RHDI per capita is not a better metric for our analysis purposes, RHDI is my favourite one for economic health and affordability of households. Households and their ability to afford rent and the pace of increases has no better proxy. The average is always dangerous. How is it in your part of the country, for example? We await the regional GDP figures for 2022, unbelievably, although they were also supposed to be released last month. But with the low paid being the only ones to have actually benefited from this parliament, and if you see the physical article on the Partners in Property website or on my LinkedIn, I've included the link to the Spectator Data website, which will show you an interactive GIF of how only the bottom 25% of households, when lined up by income, have actually improved their positions since this parliament started in 2019. Everybody else has just about struggled to break even, and actually the most wealthy have taken the biggest steps backwards. That's in real terms adjusted by CPIH, the inflation rate that includes housing costs. And look, you can argue that that's not valid as a piece of analysis because the real inflation rate for the poor has been well above CPIH because the cheapest items in the supermarket are up by the largest percentages, for example, as has been proven by a few pieces of analysis. So either the lowest paid are better off or no one at all is better off over this parliament. But I feel somewhat justified that this helps the renters. The real situation probably isn't as bad as the graph either, because when average household numbers have grown quite considerably, spreading the rent burden amongst more household members, as I've said, and the council tax and the energy bills, etc. It's moved up nicely in 2023, and it will move up even more nicely in 2024. If I'm wrong about inflation and it is quenched, wages are notoriously sticky, and with a 4% target on national living wage in 2025 already in the mixer, if inflation is 2% or under, that's another 2+% on real household disposable income. For the rest of this year, if I'm right, with inflation at 3-ish and wages at 5-ish, those are my predicted averages for the rest of the year. That puts another 0.5% per quarter on RHDI on average at least, unless households start to get smaller again. But that would require, aside from anything else, net migration to come right down. April's figure will have a nice bit of growth in it thanks to the national insurance cut as well. That might be worth another 0.5% or more. I'd have thought it's more like 0.8. The OBR have revised their net migration estimates from 250,000 to 290,000 to 350,000 per annum now over the forecast period. That's the next 5 years. The ONS estimate 315,000 per annum from 2028 onwards. Both of these don't seem to put enough weight on the post-COVID net migration statistics, which have of course been much, much higher. But there have been significant changes in March on migration, which estimate that 300,000 people who migrated to the UK last year would not have been able to do so if all of the changes in May 23 and December 23 had been enforced by then. If that is true, That would send net migration down towards the numbers that the OBR and the ONS seem hurriedly revising up towards. But all of the previous house building estimates have been built on circa 250,000 net migrants per year, not circa 350,000 or more. The number that's coming out of some of the think tanks is more like 400,000. The newer house building estimates factoring in these figures look more like 500,000 per year or more being required, based on lags thanks to COVID, and starts have not really yet got started again, and these larger net migration numbers. The problem of suitable stock just seems to get bigger and bigger as time goes on. So, time to have a bit of a summary really, quarterly. What are the overarching points of all of this data that I keep furnishing with you and commenting on? Let's try and get into a nice, tidy, bulleted summary. Number 1, real household disposable income is going up, and up nicely. Affordability ceilings are really some way from being breached. Number 2, house prices need lower rates to really start taking off. All that can drive them forward at the moment is slightly cheaper rates, a fair bit cheaper than at some points last year, and wage increases thanks to inflation. We also need the election out of the way regardless of the winner, pretty much. What we've got is still enough to drive them forward, not backward, as many bears have predicted. Yields, therefore, are still climbing in terms of property. Not as fast as last year, but ascending rather than descending, because we've got rent going up and house prices going up at a slower rate or sideways. The supply problem that we all suspected would never be fixed anyway is further away from being fixed than it ever has been. Instead, people are taking it upon themselves to form larger households in existing buildings and overpopulate buildings. Number 5, inflation isn't dead at all. Once energy price cuts drop out of the figures in July, we're right back on the climb, and tax cuts and wage rises of the level we've seen in April are inflationary on their own anyway. Number 6, rates can stay stronger for longer because the underlying economy is actually doing okay, in spite of the fact that the government has, at points, looked totally feckless when trying to manage fiscal policy. Not Sunak and Hunt, but the others. Number 7, it's cheaper to rent than to buy in certain areas. The bit from the press largely aren't getting, and that many people are missing, is that a 25% price increase from 2020 is the baseline, and so everything needs to be viewed through that context and lens. The price of shelter has gone up significantly, like everything, but ownership has gone up more than rent has at the moment in some areas, mostly because of the mortgage rates increasing so much. Number 8, households are still saving, worrying about escalation in the Middle East and Russia, at least one of which took a riskier upturn this week, and there is widespread chatter that Kyiv will eventually fall to the Russians. Number 9, investors are still selling more properties than they are buying, shortening rental supply even more. And number 10, arrears and insolvencies are up, but still under historical averages and at very manageable levels. The trends need watching closely, of course. These are the ingredients. What is the recipe? Well, you can either navel gaze and or wait for perfect conditions, or get on with it now. The future looks pretty messy from the tenancy perspective. From the property owner side of the equation, this is a Goldilocks setup. If you aren't spending time laying foundations now to build or expand portfolios, I'm not sure what you're waiting for. The perfect storm is already here, and waiting for lower rates will start to take prices away from you, as that's the final ingredient that is needed for the crack-up boom. The deals won't be as good, they won't be as plentiful, the margins will get squeezed somewhere, and you won't have had that 5% or perhaps 10% where inflation has done the hard work before rates repricing really kicks in. The natural rate in this post-industrial economy without major change is 2 to 2.5% for base. That could be 15 years away right now. It could be 10. But when it's here with bond yields to match, oh boy. Congratulations as always for getting to the end. Don't forget the Property Business Workshop on Wednesday the 24th of April. Tickets for you or anyone you know who might want one are at bit.ly/PBWTWO. So onwards and upwards as we blast through Q2. Keep calm and carry on, but not so calm you aren't being active right now.